Are you prepared for the financial upheaval that may soon hit the markets?
In this video, we'll explore insights from top strategists, including the renowned George Gammon, who foresees possible crises unfolding.
We've distilled hours of expert analysis into minutes of essential insights to save you time.
Stay tuned for surprising insights about potential market shifts that could impact your wealth.
Just a reminder, this content is for educational purposes only and not investment advice.
Let's jump right into George Gammon's critical outlook on China's economy.
In today's analysis, we delve into George Gammon's insights regarding China's economic challenges, reminiscent of the U.S. crisis of 2008.
Gammon's commentary highlights the unprecedented situation in China, especially the plummeting bond yields and a troubled real estate market.
George Gammon warns that China's economy is entering a dangerous deflationary spiral, analogous to Japan's experience decades ago.
Notably, Gammon points out that China's long-term bond yields are now lower than Japan's, marking a staggering economic shift. Gammon highlights the alarming collapse of the Chinese real estate market, which was the largest asset class globally just 2 years ago.
He suggests this collapse could rival or exceed the severity of the 2008 crisis in the U.S., as many households have significant investments tied up in real estate. According to Gammon, there has been a stark decline in consumer confidence due to substantial losses linked to real estate values.
This drop can severely affect China's economic activity, as waning confidence typically leads to reduced consumer spending. Gammon emphasizes that the ripple effects could reach global markets if China's financial woes deepen.
With the largest gap in bond yields between the U.S. and China, investor sentiment is increasingly cautious. George Gammon foresees that unless significant measures are undertaken, the economic decline in China is likely to worsen.
Furthermore, he warns that the deflationary pressures could have implications for economies worldwide, particularly the U.S.
In conclusion, Gammon emphasizes that China's financial problems necessitate immediate consideration from investors and global leaders.
He advises monitoring key economic indicators like real estate values and bond yields to gauge ongoing risks.
Today, we're reviewing market implications for 2025 with insights from Chris Vermeulen.
Chris points out that despite a surge in U.S. non-farm payrolls, the markets are reacting negatively, indicating underlying weakness.
Chris Vermeulen forecasts that equity markets could face a substantial pullback of 50 to 25% this year.
He emphasizes that rising treasury yields and bearish technical patterns are significant indicators of a downturn.
Chris explains how rising treasury yields increase borrowing costs, which creates pressure on risk assets.
He notes that this spike encourages many investors to shift to cash as a safer bet. According to Chris, weakening market internals suggest a lack of buying interest and ongoing selling pressure.
He warns that small-cap indexes are particularly vulnerable to this trend. In light of these forecasts, Chris recommends that investors hold significant cash to safeguard against market volatility.
He emphasizes the importance of risk management strategies during this tumultuous period. Chris anticipates that conditions in 2025 could echo declines observed during prior financial crises.
He emphasizes that while volatility is expected, temporary rallies could complicate investment strategies. In conclusion, Chris Vermeulen underscores that maintaining caution is vital for anyone exposed to equity markets.
He advises an immediate focus on cash or dollar-backed assets to navigate potential downturns.
Today, we're diving into Marc Faber's analysis of the economic difficulties facing U.S. families.
Marc points out that many families are struggling financially due to a significant gap between income growth and living costs.
Marc Faber states that most American families are already experiencing recession-like conditions due to affordability issues.
He emphasizes how wages have failed to match the increasing cost of living, which heavily impacts affordable housing.
Marc explains that while Federal Reserve policies can create liquidity, they exacerbate affordability issues for the average American. What does Marc say about the struggle between rising costs and stagnant wages?
Marc explains that while some wages have seen increases, they lag behind the rising costs of living, leading to widespread financial stress.
How does Marc evaluate the current housing market?
He notes that high prices combined with low transaction volumes signify severe affordability issues for potential buyers.
What does Marc emphasize about the Federal Reserve's role?
He argues that the policies of the Federal Reserve result in an environment where asset inflation benefits the wealthy and exacerbates difficulties for average citizens.
What predictions does Marc make for the coming years?
He envisions a deteriorating economic landscape where existing trends lead to deeper challenges for families and housing market transactions.
In conclusion, what advice does Marc give families?
He stresses the importance of monitoring budgets and being prepared for ongoing economic challenges.
Today, we're discussing the economic analysis provided by Cathie Wood on the current macroeconomic backdrop as we step into the new year.
Wood highlights a strong employment report with significant job growth, although manufacturing jobs were down.
Cathie Wood discusses the latest employment figures, noting the drop in manufacturing jobs, but a robust overall gain in employment.
Consumer sentiment metrics show mixed signals as uncertainty looms large.
Wood warns that while employment figures are strong, concerns about a resurgence in inflation persist.
She notes that consumers are exercising caution in their buying habits.
According to Cathie Wood, effective deregulation could unleash growth potential among smaller businesses.
She emphasizes that continued productivity improvements are essential for broader economic progress.
Cathie Wood observes differing economic predictions, with some anticipating robust recovery and others foreseeing recession.
She underscores that transparent policy communication will be key to reducing market uncertainties.
In conclusion, Wood advises investors to remain vigilant about potential regulatory changes and productivity trends.
They should also brace for a range of economic outcomes, from inflation risks to potential recession.
In this week's video, we're reviewing insights from Siovaco Capital about factors currently influencing stock market performance, specifically whether growth or inflation is more impactful.
Siovaco Capital notes that the focus should be on both inflation and growth, as they significantly shape market outlooks over the coming months.
Siovaco Capital argues that while inflation is a significant concern, the main question is whether these concerns surpass growth expectations over the next 12 to 36 months.
The analysis further examines fluctuations in the S&P 500, alluding to historical patterns observed during election cycles. Siovaco Capital highlights the resilience of the S&P 500, noting recent consolidations above crucial support levels.
This suggests that as long as the S&P remains above these levels, a trend reversal is not likely in the immediate future. A crucial indicator discussed by Siovaco Capital is the Bitcoin to S&P 500 ratio, which tends to decline during uncertain market periods.
Currently, the upward trend in this ratio suggests a risk-on sentiment that counters some inflation fears.
Siovaco Capital indicates that market corrections may occur due to ongoing volatility, yet the long-term outlook appears bullish.
They underscore the necessity of being prepared for potential excessive upward price movements, given observed trading patterns.
Siovaco Capital concludes with advice for investors to stay vigilant and continually analyze market signals.
Ultimately, an adaptable investment strategy positions investors better for unexpected market changes.
Today's discussion was a veritable treasure trove of insights.
Indeed it was. From Siovaco Capital's take on growth versus inflation to Cathie Wood's ideas on productivity, each guest brought something unique.
It's fascinating how they all acknowledge the struggles of the U.S. economy.
Absolutely. They share concerns about inflation and affordability, but diverge on their solutions.
Yes, while Siovaco Capital talks about growth expectations, Marc Faber paints a dire picture of the affordability crisis.
And how about Chris Vermeulen's warning about treasury yields? Quite the bearish perspective.
Totally unexpected. Cathie Wood's optimism seems a stark contrast to that.
That's the beauty of these discussions. Varied opinions build a richer understanding.
And speaking of understanding, it's clear these experts are urging us to pay attention to policy decisions.
Well said. If you found this discussion valuable, don't forget to like and subscribe.
Your support lets us continue bringing expert insights straight to you.
Next time, we'll explore the impact of global trade dynamics on the markets. You won't want to miss it. Stay tuned.